So what does a US debt default actually look like in terms of gold's price? Let's break it down into three possible paths, each based on real data, historical patterns, and the macroeconomic forces that shape how gold moves when the world shakes. Scenario 1, controlled chaos. Gold at $2,800 to $3,500 per ounce. In this first scenario, the US does default, but only briefly. It's a political stunt, a high-stakes game of chicken in Congress. Markets panic at first, but the issue is resolved within days. The Treasury resumes payments. The Fed injects liquidity, and leadership reassures the world. But the damage is already done. Credit agencies may still downgrade US debt again, and headlines worldwide declare the US unreliable. Investors remember the scare, and they reposition not all at once, but gradually. Gold in this case becomes a refuge, not a revolution. Prices could spike sharply, moving from current levels to the $2,800 to $3,500 range as buyers flood in. But once the crisis subsides, prices likely stabilize at a new baseline. This is a scenario of contained damage, where gold surges but doesn't explode. Scenario 2, systemic confidence breakdown. Gold at $5,000 per ounce. This is more serious. The default lasts longer than expected. Political dysfunction escalates. Foreign governments begin to lose confidence, not just in US leadership, but in the dollar itself. China and Japan begin quietly dumping treasuries. Sovereign wealth funds and central banks across the world start diversifying away from US debt. Emerging markets flee the dollar, turning to gold, oil, and alternative currencies. Suddenly, de-dollarization isn't a theory, it's a trend. Inflation creeps back in as interest rates rise and the dollar weakens. Domestic buyers, already nervous from a decade of monetary policy acrobatics, start pouring into gold. Institutions follow. In this scenario, gold crosses $5,000 per ounce, not from a blowout rally, but from a slow, relentless shift in global trust. Gold doesn't just hedge inflation here. It becomes the primary safe haven asset, displacing bonds, tech stocks, and even cash.